Have you ever noticed how even small changes in exchange rates can have such a huge impact on your life? Whether you're planning a trip, shopping online, or even watching the news, those little currency numbers can matter more than you might think. Recently, something important just happened. The UK pound, also known as GBP, dropped below 1.340 against the US dollar. And it happened just before when UK is about to release the key labor market data. But what does this all mean? Is this really important? And should you be worried or excited? To know everything in detail, make sure you stick till the end before we're just getting started. When we say that the British pound has dropped below 1.34, it means we're talking about how many US dollars does it take to buy one British pound. Before, one British pound could get you more than $1.34, but now obviously it gets you less. This means that the British pound has become weaker and the US dollar has grown stronger in comparison. So for example, if you are an American traveler heading to London, your dollars would now stretch a bit further. On the flip side, if you are in the UK and planning to buy products from the US or traveling abroad, it might cost you more now. So these exchange rates aren't just a number on your screen. It affects real things like tourism, trade, and even prices in the stores. The drop in pound didn't come out of nowhere. There are several reasons behind it, and one of the biggest reasons is the anticipation of UK's upcoming labour market report. This report includes figures like the unemployment rate, how much people are earning, and how many jobs are there available. Investors are keeping a close eye on this report because it tells them how strong or weak the UK economy is right now. If the numbers show that less people are getting hired or that wages aren't growing, it can be a sign that the UK's economy is slowing down. And that's not something investors want to see. If there is uncertainty about a country's economic future, investors tend to pull their money out of that country. But this is not the only factor. The US dollar has also been gaining strength. The main reason is that the American Federal Reserve is keeping the interest rates high to control inflation. And these high interest rates totally attracts the investors because they can earn more returns on it. So we can say that money flows into the US, creating a higher demand for the dollar and pushing its value even higher. Meanwhile, the global mood in financial markets is also a bit nervous. When the investors are feeling uncertain, whether it's due to political instability, economic worries, or international conflicts, they often look for safe places to put their money. And one of those safe places is definitely the US dollar, which is also known as the risk-off environment and is another reason why the British pound is struggling to hold on to its ground. The labor market report is like a health checkup for the economy. It gives an insight into whether companies are hiring, people are getting jobs, and if the wages are growing or not. If the report shows strong job growth and higher wages, it's a good sign that the economy is doing well. It might also push the Bank of England to increase their interest rates, which is also a good sign increasing the value for British pound. But if the data shows that the job market is weakening, for example, unemployment is rising or wages are falling behind inflation, this could be a sign that the UK is heading towards an economic trouble. And in this case, the Bank of England might pause or even cut off interest rates. And we all know that lower interest rates leads towards a weaker currency. This is the reason why analysts, investors, and traders are all waiting for this labor report because it could change everything, at least in the short term. So you might be thinking this is all for banks and investors, right? So why should I care? But this actually touches your life more than you think. Let's say you live in the US and planning to visit UK. Now your money goes further. Your accommodation, your food, meals, shopping, traveling, all would cost you less in dollars. And on the contrary, if you live in the UK and planning to buy something online from a US-based store, let's say iPhone for example, it would cost you more in pounds. This is because those products are priced in US dollars, and with a weak pound, it means that you will have to spend a bigger portion of your local currency. So what happens next? If the UK job numbers turn out better than expected, then the pound could recover and could even climb back above 1.34. It would definitely boost up investors' confidence and might encourage the Bank of England to keep fighting inflation by raising rates. But if the numbers turn out to be disappointing, the pound could fall even further. The Bank of England would be forced to pause or reduce these hikes in order to avoid a recession. This would definitely be the worst case scenario for GBP. Either way, this week is going to be a big one for currency markets. So what should you take away from all this? The fall in the pound below 1.34 isn't just a headline. It's a sign of deeper concerns about the UK economy and global financial trends. The upcoming Labour report could be the key that either restores confidence or adds to the uncertainty. If you're a traveller, this might be a good time to plan that UK trip. And if you are a UK resident, you might want to keep an eye on prices, especially for imported goods. And if you are an investor, be prepared for the possible shift in direction depending on what the data reveals. Don't worry, we'll be keeping an eye on it for you. Thanks for watching. If you found this explanation helpful, be sure to like, comment, and subscribe. We break down complex financial stories in plain, easy to understand language so you never miss what matters.